channel, guys. I just wanted to cover off a video on for youngsters, kind of teenagers growing towards adulthood. There's been a request in the Discord for me to put together a kind of video to help the younger generation understand the power of investing, the value of investing, the value of saving, and what it can mean for their future. So I really want to talk about how we can take such small sums of money, whether it be £10, £15, and turn that into 1.12 million just through the growth of your money. So I just want to start off with a really simple example of the power of compounding. The analogy that's used a lot is the concept of a snowball rolling down a hill. And so as it starts off small, it quickly gathers mass and speed, and your investments are kind of a similar kind of thing when you get to a point where it's quite unstoppable and you're just getting the greatest advantage as a youngster, which is time, which as you get older it gets harder and harder. And here's just an example of, if we put £100 a month in for 30 years, you've invested only £36,000, but your growth is £86,000. So you've got 122k. That's a huge sum of money, and that's in 230. That's a 239% return. So that's a lot of money that's just been generated just with you just putting your money in and just letting time take over. Now, I just kind of want to cover the different styles of investors. Now, ultimately, investing, and it doesn't have to be stock investing. I'm talking about stock investing today. There's obviously other forms of investing, but the advantage of stock investing is you can start with £1 now. You don't need to have huge sums of money to start. And I think it's important to find what strategy gets you excited with investing. For some people, it's growth investing. And the idea of growth investing is you're kind of betting on the future Nvidias, the future superstars, the future Teslas. You'll buy shares in companies that you expect to grow really fast. You're going to get good returns, hopefully, but you've obviously got the risks that's associated with growth companies and the volatility associated with growth companies, like Tesla share prices up and down all the time. Another form of investing is something that I look at as well, which is value investing. So this is being a bit of a bargain hunter. You're trying to find good companies that are undervalued by the market. They're either unloved because of some news that's come out, maybe because of the type of stuff they sell, and maybe there's just some market sentiment against it, but it's still producing a lot of cash, it's still producing a lot of revenue. And so I like to kind of find those that you have to kind of wait it out till the market kind of catches up. In the long term, it is kind of that weighing machine. In the short term, it's a bit of a voting machine when we look at the stock market and share prices. The other style that's very popular with the younger generation right now is dividend investing. So this is focusing on total return, and I'll come back to total return a little bit later on, but it's looking at stable companies that basically provide the growth, but they also provide some level of income. So the reason why this is quite popular nowadays is people like to see a bit of cash coming back to them, so it feels kind of real. Okay, I'm getting this, I'm putting money into something, and then they're giving me a little bit of cash back, and you'll see why that can be quite appealing. Obviously, you're not going to get as much growth as a growth investor, and you might get slower growth because typically companies that pay dividends are normally companies that are well established. They don't have anything better to do with their cash, and so they're giving it back to you for owning a piece of that company. So buying shares is you own a piece of that company, and the company says, thank you for investing in us, believing in us. We're going to share our profits with you and give that in the form of dividends. Okay. Now, you've got to be careful of very, very high dividends, which are often referred to as dividend traps, where the share price is dropping, they're not really producing the cash to cover the payments to you, and so then you see these crazy yield numbers, and that are not realistic. Now, the final group is the income investor. these are more focused on getting that income, and they're not too worried about growth. It could come in the form of very safe or safer income investments like bonds. It could come in the form of REITs, which basically are stocks where they own a bunch of properties and they rent those out. They collect the rent payments and then they share some of that rent payment with you. So you basically become a proxy landlord in effect by owning a REIT. The problem with REITs can be that, again, because they're a share price, it's not always directly connected to the assets that belong to the REIT. So the properties and things like that are not always aligned with the share price, because obviously share prices are kind of not only driven by the fundamentals, so the financials, but also driven by the emotions around that particular stock. There is also newer style income investing where they invest in strategies like covered calls, where basically you own a stock and then you are able to offer that stock to the market for a set price, okay, known as a strike price. And so the idea here is that you're willing to give away your shares for a little bit of extra money up front. And then if your shares go through that strike price, you then have to sell your shares. Otherwise, you keep them. You keep the shares and the income that you've generated. So again, depending on the style of investor you are and your risk tolerances and your risk level and your understanding, there's different styles of investing. And I just kind of wanted to visualize this in this kind of pyramid. So if we kind of just filter out all the others and just focus on growth investing, obviously there is a lot of potential growth, but there is greater risk potentially, because there is some of these growth stocks could go nowhere, or they could end up becoming hype stocks. If you look at GameStop, a very popular one of late, if you've gone in at the highs, then you'd be quite punished right now for it. And again, talking about GameStop, the volatility of it is all over the place. And we've seen that with Tesla, right? Tesla's highly volatile. But then you can have very stable growth stocks like the Apples, like the Googles, where again, they still might have a lot of potential growth, the Nvidias, but there is still an element of risk involved in doing that. Okay. If we start to look at the pure value investing plays, so these are companies that are really don't have as much growth, but they still have a lot of, they have a lot less risk, they have a lot less volatility. So if I was to look at Intel, Broadcom, there is still growth there. There is still a little bit of volatility, but the risk isn't as high because they're a lot more stable in terms of their financials and their balance sheet. So you can get some stocks that sit in between those. So an Nvidia is a good example of where it could be argued as being a very good growth play. The reason why it's not a value play is because its price to earnings ratio is very, very high. And I'll do a separate video for you guys on kind of the fundamentals and how you analyze each of these categories if you all think that's relevant. Put that in the comments, by the way, if you want me to cover that in a bit more detail. But I think that a really nice example of this is Nike right now. If you were to look at Nike's share price, it's quite beaten up. But, it's one of the strongest players in the sports apparel space. So do I think it's going to go anywhere? No. Do I think it's slightly undervalued? Yes. And so there's a good example of one where it still has a little bit of growth left in it. It's not that volatile and the risk is relatively low. Okay. If we start to look at the next category now in terms of dividend investor. So there's obviously a lot of income on the table with a dividend investor. As I said, dividend companies that are issuing dividends don't typically have as much growth. As I said, they've used up that growth. They've maximized, probably they've got a moat. A good example of this is Coca-Cola, right? Coca-Cola is a well-recognized brand. It's very hard for it to grow quickly now. It's very established. Its risk level is very low. It's consumers are global. It's almost a consumer staple item. Its volatility is very low, but it has a decent amount of income. And so dividend stock investing is good if you invest in those stable companies that can generate a bit of income. And obviously that dividend income can also fuel other types of investing. So you could fuel value investing or growth investing using that income. So obviously the other advantage of the dividend investor is, we talked about you having to put in that £100 a month. Well, the beauty is if you're getting some of that income in, you can use that and compound much faster using that income. Okay. And then if we look at the very final group, it's the income investor. Now, obviously the challenge with becoming an income investor is you're not going to see huge amounts of growth, if any, sometimes. In fact, arguably you might even see a bit of decay and a bit of return of capital. And so the income investing is typically reserved for investors who have typically not got a huge amount of time horizon left. And they may be a lot older, they may be in their 50s, and they just want to eke out the income now. They've done all their growth when they were younger. And sometimes you'll turn from a growth or value investor into an income investor later in life. Now, I've kind of put the risk level as low, but it depends on the type of income investing you're doing. Some income investing has higher risk levels than others. And if we look at the volatility again, that can be different depending on the type of income investing you're doing, whether that be retail investing, issuing bonds, if you're issuing debt, if you're issuing REITs. So if I was looking at bonds, the risks would be a lot lower, corporate bonds. But if I'm investing in those covered call strategies, the risks would be substantially higher. Okay, let's also talk about, like, what are we investing in? So investing is kind of owning a piece of a company, as I said, across the globe. And a lot of companies are now global. So they might be established in one region, like Google, as an example, is established in America, but it sells products everywhere. And we've all got, some people have got Android phones, some people use their Gmail service. And there's the search engine, YouTube, which you're watching this on right now, is all owned by Google. And then the markets are generally split into two types of markets: the developed market, like the US and the UK, and the more stable emerging markets like India and Brazil. So obviously the emerging markets have higher growth potential, but there's obviously a lot more kind of risk to kind of balance that out. So again, just to visualize this, if I was to just focus on the US market, it's the biggest size market out there. In comparison, it doesn't have as much volatility as the developed markets. It's got good sustainability. There's a lot of innovation going on right now with these tech firms, and there is still a fair amount of growth out there. If we start to look at the Indian market as an example, there's a lot more growth potential, but there's a lot of volatility because these are a lot smaller companies, less established. There's still a fair amount of innovation going on. The stability isn't always great, and the market size is sort of mid, it's sort of growing. So again, you've got to decide, depending on the style of investor we looked at earlier, and depending on the different risks, you need to kind of think about how you're going to spread that across all of your different styles of investment that you want to do. And a simple way to invest globally throughout the globe is for a fund or what's called an ETF, or exchange traded fund. What this allows you to do is own a basket of these stocks. So you don't have to worry about, is it developed? Is it emerging? Am I taking a huge amount of risk? Does it have enough growth? Does it have enough stability? These ETFs are very simple. You just buy one of them, you put money into them, and they own a basket of these stocks. Okay, so it gives you the diversification, it reduces your risks, and it means you're not putting all your eggs in one basket or in one region. So there's that good mix that's out there. So where's the real superpower here? It starts with, for those of you that are in the UK particularly, there is the concept of a junior ISA, and it's not used often enough. And I think it's a really good starting point. And for parents out there watching this video, if you haven't started a junior ISA for your child yet, I highly recommend that you do. This is for any child that's under the age of 18. And in the UK, a junior ISA basically lets you invest with your growth completely tax-free until you turn 18. So there's no tax on your profits. There's no charge on your dividends or any interest payments. It compounds a lot faster. So if I was to take £100 a month from age 10 to 18 at a 7% average return, that's you're putting in 9,600, and that could become 12.5k. So that's a 30% return that's completely tax-free, which is crazy. Obviously 7%, I've taken into account inflation there into that number. Obviously, the more years that you have, the larger that sum becomes. And then the good thing is when you're younger, you have the ability to kind of ride out those bumps in the road. So it's really straightforward. Open an ISA account, add the funds into the account, and then just invest into a diversified set of stocks. I've actually got a video planned around the different types of all-world funds, and I'm going to get that out next week, hopefully, which talks about these diversified baskets. In terms of a lifetime journey, I talked about this golden 1.12 million. How do we get there? So if you were to start at the age of 16 and take control of your investments in your junior ISA, and we looked at this kind of taking it out from the age of 18, you automatically becomes an adult ISA. So a junior ISA is obviously up to the age of 16, and then once you turn into full adult, it turns into a full ISA. But here is where things get really crazy. So imagine a real world example of a 7-year-old starts with, let's say, a £250 gift voucher and starts adding £10 a month and just increases that £10 by inflation, but stays invested in a global fund for 58 years. You've turned that into 1.12 million. That is just insane. That is 97% of the final value came from compounding growth alone. You put in only £34,550, which still sounded like a lot of money, but across 58 years, that's not a huge amount. And that is turned into over £1 million in that time. I mean, that's just ridiculous. And you're not even putting in a huge sum of money here over a long period of time. So I think this is a real big important takeaway, that you could even become financially free even quicker. I've seen people become financially free in their 30s, in their 40s, some even in their late 20s, just because they're willing to sacrifice a little bit of cash, let it grow, let it compound, because time is their friend, and then they are much better off. So being able to own a decent lifestyle in your mid-30s to 40s, just by saving up now, and when you're in your teens or even slightly younger, is so important. And so the financial freedom is not just about not working, right? It's about having a choice. There are a lot of people, probably parents, if you're watching this, a youngster, or even parents that are watching this, maybe looking to do it for their children. It's how much of a choice did you have in the job that you chose to do, and then you hated it because you were just doing it for the paycheck because you need to live, you need to put food on the table, but you wanted to do another job, but it just paid a lot less. You enjoy it a lot more, but it just didn't pay you much. So by creating a portfolio that gives you a bit of growth and income, can almost feel like a freedom fund, right? That will pay your bills, you'll work less, you could potentially retire early, or you could just go and do some hobbies and interests that you just want to do. You've got a lot of options then. So a good way to look at this is putting 60% in global stocks, and then putting maybe 25% in a a dividend ETF, and then maybe putting something in something more stable like global bonds, for example. And that's a really good starting point. So again, just another freedom scenario here. What if I was to invest £250 a month into a portfolio from the age of 20, assuming again that 7% total return? By 50, that pot could be worth over 350k, potentially generating £1,000 a month. Now, again, I've taken a very conservative view here in terms of the amount of income it can generate, but you could see that potential of how quickly things can grow and compound. And the thing is, when you get to the first 100k, it's easier to get to the next 200k and then the next 300k and so forth. I just wanted to kind of put a bit of a glossary here at the bottom, and you can pause this video just to kind of read this back for yourself. But I just wanted to quickly throw out some key terms that you need to understand when you are getting involved in investing, particularly for some of the newer people and younger people out there. So an asset is basically anything you own that has a value, and it could be money, it could be property, it could be any kind of investments in the stock market. Okay. A bond is typically a loan that you give to a company or a government, and they pay it back with interest. Okay. So this is where you might say, okay, I'm going to give you a loan because you want to expand your business. And then based on me giving you that money, I want to have that money back plus a little bit extra for giving you that money in the first place. And that little bit extra is known as the interest. Okay. And then they could pay you a different percentage based on what you're willing to give it to. So it could be a 1% on the money, 2%, 3%, 4%, etc. I mentioned earlier around investing in these types of stocks where it might be a basket of stocks, or it could be a particularly traded fund. And this funds are called exchange traded funds, and they trade on stock exchanges. Okay. A stock exchange example would be the London Stock Exchange, or in New York, they have the New York Stock Exchange in America. Okay. Diversification is very simply spreading your investments to reduce your risk. Okay. So the idea is not to put all your eggs in one basket, i.e. a single investment, a single property, a single stock. The idea is to buy multiple companies, like instead of just owning Apple, you might own Google and Apple. Okay. The return is basically the money you make or lose on your investments, which is typically shown as a percentage normally. So if I was to sell Apple when I made £100, that is the £100 is my return. Volatility is basically how much that investment moves up or down. So it swings. How much does it go up? How much does it go down in a period of time? Capital gain is the amount of profit you make when you sell an investment, typically for more than you bought. Okay, so it could be I owned Apple, I bought it at 100 and I sold it for 110. Okay, so that capital gain is that 10. An ISA is a very specialized UK account for adults, typically over the age of 18, where you can grow your money tax-free. And that's really important. The tax-free part is really, really important. If you look at how much taxes are taking and eating into your returns, it can be quite a substantial amount. A stock or a share is basically a tiny piece of ownership in a company. Okay. A fund is a collection of different investments like stocks and bonds, normally managed by a group of professionals within it. So again, we've got exchange traded funds, normal funds, and then we've got something called index funds. So a fund that aims to basically match the performance of a particular index. An index could be the S&P 500, which you may have heard of, or it could be the FTSE 100, which is the top 100 companies in the UK, and the S&P 500 is the top 500 companies in the US. Okay. Portfolio is basically just all your investments put together. Okay. Risk is the chance of your investments losing money. Okay, so that's just the risk element. Dividend, as I mentioned earlier, is a payment made by a company to its shareholders from its profits. So a company could be making a lot of money, it doesn't know what to do with that money anymore, And so it decides to give it to its shareholders for thanking them for investing in their company and believing in that company. Inflation is a very important metric when we talk about any kind of investing. And it's the rate at which prices increase, basically meaning that your money buys less. So if you had £100 in your pocket today and you just left it there for 10 years, it would erode at 3% a year, meaning that £100 would be worth less in 10 years' time. Expense ratio is another really important thing when you're investing in funds, particularly. It's the charge the fund gives you and it's normally expressed as a percentage of what they're going to charge you to help manage the fund. So the idea here is less is more for you as an investor. And for each fund, you could have different fund managers that give you the same fund exposure, like on an index, let's say, but some of them will have lower fees than others. So the aim here really is to just pick the one that's got a good performance but lower fees. Okay, so there you go, guys. This was a community ask, so hopefully it was a good video. Put in the comments whether it was useful to you guys. Did it meet the requirements of what you were hoping for? As I said, the key here is how quickly you can do that compounding element of putting a small amount of money today and how quickly that can turn into millions in the future. It also talks about that financial freedom element. So hopefully you really enjoyed that one, guys, and I'll catch you on the next one.